And good afternoon, everybody. Welcome to the Preccelerator. Today's workshop is on Regulation CF or crowdfunding. And I'm excited today to have two of our attorneys from Stubbs, Alton, and Markleys present to you. Durdana Karim and Jose Ortiz will be our presenters today. And also I want to give some recognition to one of our senior associates who helped put this presentation together, Gary Chen, who is out of the country right now. Gary's online, so Gary, welcome. Good to have you here, and we will get started. Just so you know, if you're not here, if you were here, we have a beautiful lunch, and you can see some empty chairs. So if you're not far away, come on over and join in. Otherwise, in the future, all of our workshops will be hybrid, but we're going to transition to more of an in-person situation. So please sit back, enjoy. Both Durdana and Jose are going to go through the presentation, and then they'll have questions at the end. So with that, I'll turn it over to Jose.
Thanks, Len. Hi, everyone. So as Len mentioned, we're covering regulation crowdfunding today. But in order to get to what that means and why it's important for the common investor, we'll start with some background information on just securities regulation in general and investing in general. So we'll begin with just this legal disclaimer that we want to provide information to anybody who might be able to use it, who might find it helpful, but we're not providing legal advice to anybody in specific. You can read through this disclaimer in detail and look at it after the presentation, but the long short of it is we're not your attorneys. We're not anybody's attorneys in this room. We're just providing information that might be helpful to anybody looking to invest. So we begin with just some background information on the Securities and Exchange Commission. This organization was created after the Great Depression, or during the Great Depression. After the market crash of '29, it took the United States government a few years to pass these laws, Securities Act of 1933 and the Securities Exchange Act of 1934. After the Securities Exchange Act of 1934, the Securities and Exchange Commission came about. And this organization was really created for the benefit of you guys as the investors. And the purpose of the organization is to make sure that companies seeking investment from anybody investing into companies, that those companies are being honest about their business, about what they're doing, about how they're doing. And it's also to protect the investor. The companies that are seeking investment should be looking after the interest of investors first. That's one of the problems that arose from the Great Depression and there not being enough regulation. So the Securities and Exchange Commission came about to protect investors. And the general rule that has been basically carried through today is if a company is selling securities, the company has to either register them through the processes that are set out by the SEC, or those securities that are being sold by the company have to be exempt from registration. And just general questions that come up, what are securities? Well, what does that mean to buy a security? And also, why does it matter for anybody who's not the company what registration is versus what exemptions are? So the term security is pretty broadly defined in the US code. And it's broadly defined because it's meant to capture anything that a company might be doing in order to raise money. And it's meant to capture a lot of different ways in which companies may be doing that. So this definition is only part of the definition in the US code, but you can see there's a lot of things that fall under it. A note, stock, treasury stock, security or future, so on and so forth. I left the last one in investment contract because there's been a lot of case law regarding what an investment contract is. And that's sort of where we get the idea that a security is really meant to encompass almost anything that a company could be selling to people in order to raise money. This list is not exhaustive, and even the definition itself in the code says that everything defined here is not what we're limiting securities to be. It's everything that falls under this definition, but also things that are similar to it. So those are securities. The registration process is a process that a company selling securities has to go through. And generally, this is a long process. It takes a lot of time. It takes a lot of money. It takes a lot of effort, because the Securities and Exchange Commission, as you recall, was put there to protect the investor. And one of the things that came up was people were investing into companies without really knowing anything about the companies, or companies were maybe stating things that weren't entirely true. So this registration process was put in place so that anybody that is investing into a company, if they're provided all this information by the company, they would be able to make well-informed decisions about whether they should be investing into a company or not, whether they're able to take the risk of that investment. So some of the things like filing a prospectus and providing audited financial statements, those are all heavy burdens for a company, and especially companies that are just starting out, startup companies and venture-backed companies. It's really not something that the majority of startups will even attempt to do because of how much money it costs and how long it takes. So yeah, this is the background for registration, and why, in this context, we're more looking for, well, if a company doesn't want to register, then what can the company do? So exemptions are rules, regulations passed by not only the federal government, but state governments and entities that basically allow a company to not have to register their securities, not go through that process. And it allows the company to do that because these exemptions also have strict requirements. And there are different categories of exemptions that a company seeking to sell its securities may choose to take advantage of. Some of the common ones are private placements under Rule 506B, general solicitation, that's another common one. And something we'll go more in detail today is regulation crowdfunding, which is a relatively new exemption, but it's already pretty popular for startup companies. And we'll cover more details as to why that's the fact. So in regards to securities exemptions, there are requirements, and a lot of these requirements tend to be similar. So one of the common requirements is, well, how many securities or how much in securities can a company sell during any rolling 12-month period? Another big requirement or issue to look at is, can a company use general solicitation? Meaning, can a company go out and to any person that might be interested, say, look, these are the securities we want to sell you, and this is the information we're providing. Another requirement for exemptions is, are the securities that are being sold, will they be restricted securities? And this is one of the big things when it comes to companies relying on exemptions, is that a lot of times the securities they're selling will be restricted, and a lot of times the company, even if they can take an exemption, the company will be restricted to who the securities can be offered. And when looking at, well, what sort of people or what sort of entities can be offered these securities, the biggest differentiating factor is the person or the entity that we're offering or selling securities to, are they accredited or are they not accredited? So this can be, broken up into two simple categories: accredited, non-accredited. Accredited for the average person, an individual, not an entity, means having at least 2 years of income over 200,000, and another one is having a net worth or assets above 1 million, but that also excludes that person's primary residence. So again, these rules and these restrictions are put in place to protect the investors. So when companies are looking at what exemptions they can take advantage of, one of the big things they look at is, well, can we sell it to unaccredited investors or can't we? Because if you look at only those people that are accredited or those entities that are accredited, it really limits the pool of who a company can seek out investment from. So a non-accredited investor is everyone else, either an individual or an entity, and they don't meet the requirements under the SEC rules and regulations to freely invest in companies. So there's I would say stricter requirements in place for companies that are seeking investment from non-accredited investors. And this goes back to the point of, well, what's the purpose of the SEC? It's to protect investors, and companies still want to be able to reach non-accredited investors because that's a big pool of people that might be interested in investing but would otherwise be prevented from investing. And recently, and I say recently, but this has already been years ago that it was passed, but regulation crowdfunding was put in place to sort of offer a different solution, a different exemption for companies and a different avenue for investors. So at this point, I'll pass it over to my colleague Jordana to talk about regulation crowdfunding a little more.
Thank you, Jose. So yes, as Jose was saying, that regulation crowdfunding came about actually around 2012. When the Jobs Act went into effect. This was around, the recession, and so the government was trying to look to see how we can restart the economy, and so regulation crowdfunding came into effect around that time, and it allowed startup companies, early stage companies, to be able to seek investments from non-accredited investors through this crowdfunding exemption. And there's a difference between crowdfunding and equity crowdfunding. So, or reward-based crowdfunding. And equity crowdfunding, it's a mechanism that enables investors to be able to invest in a startup company that's offering securities through regulation crowdfunding, through all of the exemptions, in exchange for equity, in exchange for a security in the company. Compared to reward-based crowdfunding, which you'll see in Kickstarter, Crowdfunding, Indiegogo, these other platforms, the individual that is putting money to these companies, providing money to these companies, is often just receiving some type of rewards, gifts, potentially a pre-order of a product or a service, but they're not getting the potential to receive growth in the capital of that company. And a prime example of this actually happened with Oculus. It campaigned through Kickstarter, raised about 2.5 million, and it sold eventually to Facebook, or what is now Meta, for about $2 billion. And the individuals that provided capital during that time, or not invested, but provided money through Kickstarter, didn't receive, that payoff at the end of it when Facebook purchased it. And so there's a huge difference between what's considered equity crowdfunding and just reward-based crowdfunding. And I can explain that a little bit more in terms of qualifies in the regulation. And so there are certain types of requirements in order for a company to be able to offer its security through this exemption. It includes, like Jose was explaining, that there are certain types of limitation and the amount of capital that can be raised. It's $5 million in a 12-month period. And investors, there are certain types of restrictions on the amount of investment an investor can put through based on annual income and net worth, restrictions on resale. Most of the securities that are offered through regulation crowdfunding generally cannot be resold within a one-year period. The eligibility is limited to U.S. companies. It's not eligible for non-U.S. companies, public companies, companies that report through the Securities Exchange Act. And then the most important aspect of this, both for the investor and for the company, is the disclosure requirements. One of the biggest kind of aspects of being an informed investor when you are investing in any type of security is making sure you understand what exactly offered, what kind of company is this, who are the officers and directors of that company. And so the SEC implemented the requirement that most companies file a Form C, and the Form C has a lot of disclosure requirements. It's almost 100+ page document that's filed, not as much as a prospectus in terms of when a company is going through an IPO, but it is a pretty intense document that includes information about the company, information about the financial perspective of the company, information about the risk factors, information about who the officers and directors are, information about what exactly the type of security that is being offered, in terms of how much of the offering may be used for certain fees. That's also disclosed. And so it's one of the most important documents that an investor can look at to make sure that they're understanding what exactly are the risk factors of investing in a startup company through regulation crowdfunding. The other important aspect of the requirement is that the offering must be made through a registered broker-dealer or an internet-based crowdfunding platform. And this is, which is usually qualified under FINRA and meets certain requirements through the SEC and FINRA. And these are the platforms that you'll see, like MicroVenture, Start Engine, Seed Invest. These are platforms that have qualified under the requirements to meet, what an online portal is.
Yes. Can I ask questions, or you're going to have questions at the end?
I mean, you can ask the question.
Is my understanding from the previous slide, is there a maximum that investors can invest from this one, or? Yes.
There's a certain maximum that an investor can invest based on their annual income and net worth. So it's a limitation on the amount of investment. This is, again, to protect the investor. They're not accredited investors, and they may not be able to fully understand, the risks that are involved in investing. You may lose everything that you're investing. So the SEC wants to restrict the amount an investor can invest if they're not accredited. Yes.
Okay.
Yes.
Yeah, also, he said that the equity crowdfunding is not available for non-US companies. So what's the definition of a non-US company? Does it mean that they don't have a stock at least on the New York Stock Exchange, or their headquarters is not based
in the US? Well, general overview, because there can be a lot of exemptions to that, but a general overview, it needs to be a company that's formed in the US. But there are certain types of exemptions if a company, there are certain types of exemptions in terms of what qualifies the company as a US company, but most of it is you have to have a formation in the US, one of the US states. Yes.
What's the exemption they will consider?
It depends on how much I think it's investments that they have in the US. Like companies actually actively has I think they're offering either their services or they have a certain amount of contracts. I'd have to explain that a little bit more, and we can look at it. I can discuss that a little bit more. Yes. Okay, so back to the online portal, in terms of when an investor, the common structure in terms of when an investor invests through these platforms generally, and especially if you look through more of the well-known micro venture, other types of platforms out there, most of the investors will invest through the actual platform, and the platform will aggregate that investment and invest it into that startup company. And so usually that's done through an SPV, like a special purpose vehicle, and that's what's listed as the owner of that equity. It's listed as the entity that owns that equity in exchange for all of that. And so a lot of the times, the individual investors are not part of the cap table or the direct listed as the direct owners of the equity. It's usually the SPV. That's not typical for all platforms. You'd have to go to the platform to make sure that's the process, but this is kind of the common structure that you'll see. And then types of securities that are offered, this is again not an exhaustive list, but generally what you see in most equity crowdfunding is there could be common stock, which is pure stock ownership, equity interest in the company, preferred stock, which has preferential rights. Membership interests are offered if the company is a limited liability company. The debt version of this is promissory notes. It's rarely seen on equity crowdfunding. What you're typically going to see is convertible notes and something called a simple agreement for future equity. So convertible notes are typical, very general explanation. They're non-debt equity instruments that convert into equity upon occurrence of a future event. And usually this is after the company is going through another raise. They're going through a Series A angel investment raise, and they've received a minimum amount of $5 million investment. The note can convert at that point. Sometimes the holder is given the option to either receive back the capital that they've invested or go on and convert their note into common or preferred stock. A SAFE is very similar, except that it only allows it automatically converts after a company has gone through that raise. It doesn't have that option to be able to receive the equity back. And then let's see. Okay, so what are the benefits of Regulation CF or Regulation crowdfunding? Most of the benefit, I would say, of course, it is one for the startup company. They're early stage companies, they want to get investors, but they may not have access or the ability to seek out accredited investors. This is a great opportunity for early stage companies to get lots of investments early on to be able to create that prototype and get to that next level. It is an alternative form of getting capital rather than a traditional business loan that companies can go and seek. And again, it's offered to non-accredited investors, so you're able to communicate with your family and friends and to say, hey, because there's certain limitation or there's certain allowance on general solicitation, you're able to go and seek investments from a larger crowd of individuals. The founders are also not giving up board seats. Typically, when you go through a Series A, Series B raise, you may be working with large venture capital investments, and a lot of the times these investors are seeking board seat, board observation, rights and certain rights that come with registration of the security or, right of first refusal, co-sale. There's a lot of rights that can be given away as, early on in the company that a lot of founders do not want to go through. And then the important part for both the company and the investor is really that Form C. It's that disclosure requirement. It's to be able to view all of the information in terms of what this company is. It's beneficial both for the investor and the company. And then as with anything, there's a lot of risks in terms of when you're investing in early stage companies. We always, well, not we, but everyone always should should review in terms of the risks that are involved in any type of investment. Due diligence is really important in terms of making sure, what this company is, what are the risks involved in it, the liquidity. Most of these, as explained before, that the securities are not, you're not able to exchange the securities or sell and resell the securities as you would be in a public stock exchange if you're purchasing securities from a public company. The securities that are being offered through Regulation CF are highly dilutive in terms of the type of security, because the company will offer additional securities, will likely offer additional securities. And so the value of an investor's investment in that specific security through regulation crowdfunding is diluted. Most of the offerings do not have anti-dilution rights. So investors should understand that you're investing on security that could be diluted. Most of these securities do not have voting rights as common voting right holders may have, or other types of shareholders may have. And then access to information. Although the company is, again, required to provide that Form C and to disclose certain information, financial information, the risks involved in that investment, who the officers and directors are, investors are not able to have the right to additional information or able to monitor continuously their investment. And so it's really important to understand that these are a lot of risks. They're not inclusive in terms of all the different types of risks that are out there, but these are the general risks involved in. Yeah. And then anyone else have questions?
The limitations on investors' amount to invest, is that per investor per year, or is that per deal?
I believe it is per year. I will come. Yeah, it's per year in terms of their investment. I'd have to look more specifically into it, yeah. Because it's looking at two categories. And also, in general, the SEC is constantly changing. It's a body of law that changes as with any US regulation. And so some of these updates came into effect actually during the pandemic to allow for more, for investors to be able to invest a little bit more. So there were a little bit of minor changes in terms of, yeah.
One of the surprises that I got, I'm going through a crowdfunding round right now, is that you cannot invest if you're from different countries, meaning the CF regulation has a list of countries where you can invest from. So everybody needs to be cautious of that, because if your network, if you will, is in a specific country that you cannot offer, it becomes an issue.
Yes, because in general, and Jose kind of went over this, most U.S. securities laws is federal and state. An investor isn't technically restricted, a non-U.S. investor isn't technically restricted from investing in equity crowdfunding through a platform, but their state, the specific domestic country, may have a restriction. And a lot of the times, platforms like Microventures, I believe, restricts European investment, Canadian investment. They just don't, because those countries don't allow the investor to be able to invest in a platform like this.
No, but in specifics, the CF regulation has a list of countries where you can from, and then if you are not in the list, then you cannot invest. A person from that country cannot invest.
I mean, this also, I'm going to move over here. So this comes up in companies using really any exemption, because there are restrictions placed on foreign persons investing, and sometimes that's by the type of person, the type of entity investing, and sometimes, like you mentioned, that's by state. So it's not specific to only Reg CF. It's actually the securities laws of the U.S. in general will place restrictions on foreign investment. So as with anything, you would have to look specifically well, what applies to this scenario? What applies to this company that's trying to raise through this exemption, and what applies to me as the investor? But yeah, there's restrictions on a lot of investment behavior.
So ICO, are they subject to the same regulation and same kind
ICO, like initial coin offering?
of so-called offer?
Coin offering. So yeah, that's another good example of how the federal regulation of securities is just trying to catch up to what's going on in our modern day. So everyone knows what tokens are, what coins are, and these have become like a huge way companies and entities and really anybody can raise money. So the SEC has put regulations in place, and coins are considered securities. But again, that's a very recent development in federal securities laws, and that's, you know, if a company is trying to raise money by selling coins, they have to look at a completely different set of requirements or rules and restrictions in place with an initial coin offering, as opposed to, you know, trying to use Reg CF for raising capital.
So recognize you may not have necessarily prepared for this type of question in a presentation like this, so if you haven't, that's fine. But I'm just interested, and I imagine people watching might be interested. What's involved more specifically in preparing a Form C? What's involved in terms of the nature of the effort that's involved, the type of the information that's involved, what the legal expense might be to prepare such a document, and then you have to prepare that in advance of going out onto a platform to see if there's any investors that are going to actually be interested in your offering. And so, do most people who are using CF offerings expect the platform to deliver investors to them? So, like what I'm asking is like the interplay between, you can't just like go out there and try to raise money. You have to spend some money here and prepare a serious document and do some serious legal work and be prepared for a diligence investigation and all that stuff. And then you still don't know whether you're going to get investment. What's the probability of that? That's sort of the question.
So do you want to talk a few specifics about like a C filing?
Sure, I mean, we can also pull up like an actual, do you want to try to?
Yeah, I mean, we could pull up an example of this, but
Yeah.
Just talk generally.
yeah, so generally for companies that are using, for example, microventures, they have to go through this entire process of preparing these documents, preparing these disclosures for investors. Using the example of microventures, they have their website, their platform, where anybody could just go to microventures and see what companies are raising money now. And anybody can go there and see like the companies that are raising money now and what documents they have they're disclosing. But it's by no means a guarantee that, yeah.
Yeah, it's not a simple document. And for most companies, it's highly recommended to seek legal counsel to be able to draft that document. Now, it's not the same cost as preparing a prospectus, which is much longer. It's much more of a heavy disclosure. There are requirements to get an independent financial report on the disclosure on Form C. And so there's still an expense in terms of startup company or early stage company to preparing a Form C. It's not something that is easily prepared. Again, it's like 100-page something document that's disclosing the risks involved in it, the financial aspect of the company now and the future. What's the future perspective? So it's a detailed document. It's not as detailed as other types of, so it's a little bit less expensive compared to other forms of offerings that are made that have exemptions. Private placement memorandums can be almost 400-something page documents, and so it's definitely an expense to a company in terms of just making sure this is something that they want to seek. And not all companies may benefit from crowdfunding. It's something that a company needs to go through and make sure that it's it's a decision that's informed in terms of, yes, this is a benefit if you want to see investments through this exemption. It's not for every company.
So
To that point, so I just went through this recently. It is a very detailed, very cumbersome situation. I didn't expect it when I was signing in, but once I was there, you have to be totally dedicated. You have to find financial for the past 3 years, month by month. You have to have reviews of the security. It's a complete due diligence process. And so it does take time, it is costly. You have to hire accountants to review of your financials. You have to hire lawyers to review your prospectus, and then you are ready for being in the platform. But the process is cumbersome and takes time and it's costly. Yes.
I will say that the process is cumbersome and takes time and money, but it's a lot less expensive than doing a Reg A or just a straight equity raise.
I think through both of them, then yes, that part is true. Especially the keeping of the cap table and the investors' relations and that part, yes.
I'll pick on Tanya from Blockforms. This is another Preccelerator company that has engaged with microventures in a CF round. Tanya, any learnings or discoveries that you had when you signed up for microventures? I know you're out there.
I think I saw a text.
She may be double tested.
I can chime in, Len.
Oh, yeah.
Our experience, with microventures, it's been a great experience with them. But in addition to the due diligence and providing the reports and the business plan and the strategy that we have and current customer contracts of things that we have coming in, we had to be approved by the platform to even go on there. So they did some due diligence in our business. That it's not just like you can submit these and you're automatically approved. You have to be, considered to fit within their market and their team and their belief. They don't want to bring in companies that they don't have success. So there is another layer of diligence that goes into that.
All right.
Well, Bennett, what would you say the advantage of doing a CF round is in the case of Blockforms? What were you able to do with your potential investors?
Great question. I think it really comes down to the ability to raise funds quickly and also to get through a diligence process. The putting all that together is a really important step for a business that's going to be raising funds and going through microventures, or if you're going through diligence with a VC, it's a really important step. And I think, and I'd recommend that for a business that's looking to raise capital. And also there's the emotional element, being able to bring in friends and family. It's a very reasonable way to do that, as opposed to trying to bring in outside counsel to structure friends and family agreements prior to an angel round.
Very good. Thank you for those answers. Does anybody else have any questions while we have these two brilliant lawyers here? I don't see anybody asking any questions. So at this point, I'll thank Gardana and Jose for their presentation. Thank you for being prepared. Thank you for bringing your wisdom. And please stay tuned for our future workshops with the Preccelerator. And with that, I think we can call it a day. Thank you very much, everybody.
Thanks, everyone. Thank you.